Welcome to the deep dive. Today we're taking a closer look at Arvind fashions. We've got a research report here from Nuvama Wealth Research.
That's right.
And our mission really is to cut through the noise and pull out the key insights, how they've been doing recently and what the future might hold based on this report.
Exactly. We'll sift through the numbers, the performance, the outlook, and try to give you a clear picture of what Nuvama's analysts are seeing.
Okay, let's jump in. First up, revenue. The report flags a 9% year-over-year growth in Q4 FY25. That brought them to INR 1,189 crore.
Which was actually a bit better than expected, wasn't it? The estimate was around INR 11 to 132 crore.
Yeah, exactly. So a decent beat there. What's driving that growth?
Well, the report points specifically to their retail and their online direct-to-consumer or D2C channels. Those seem to be the main engines.
Okay.
And within retail, they saw like-for-like sales growth of 5.2%. That's pretty healthy.
Right, and like for like, just to remind everyone, that's sales in stores open for at least a year, so it strips out the effect of just opening new stores.
Precisely. It gives you a feel for the organic performance of the existing stores. And looking at the full year, FY25, overall revenue was up 8%. So consistent growth.
So it really seems like that direct connection retail and online D2C is where the action is. The report breaks down the channel mix for Q4. Retail was 42%.
Yeah, 42% retail. Then wholesale was 33% and online was 25%.
How does that stack up against the year before? Any shifts?
Just slight changes, really. The previous year was 41% retail, 35% wholesale, and 25% online. So you see retail nudging up a bit, wholesale dipping slightly, and online holding steady as a percentage.
Okay. And digging into that retail performance a bit more, mid-single digit like-for-like growth across all 5 brands, that sounds pretty consistent.
It does, and management seems committed to physical retail, too. The report mentions they plan to increase their retail area by about 15% per year.
Wow, 15% is quite ambitious in today's climate.
It is, but in a market like India, that physical presence, that brand visibility, it still counts for a lot, alongside the online push.
Makes sense. And speaking of online, that channel grew 9% year over year.
Yes, and what's interesting there is the online B2C component, selling directly via their own website, that part grew a really strong 20%.
Ah, so they're really pushing their own platform.
Seems like it. And strategically, that makes sense, right? More control over the supply chain, the customer experience, potentially better margins than selling through third-party marketplaces.
Right. Okay, but the wholesale channel saw a bit of a decline, down
Sure.
2%.
It did, yeah. A slight dip there. The report doesn't spell out the exact reasons, but you could speculate it's partly that strategic focus shifting more towards their direct channels.
Could be. It fits the pattern we see elsewhere, too.
Yeah.
Okay, let's switch gears to the brands themselves. Tommy Hilfiger and Calvin Klein seem to be doing particularly well.
Absolutely. Double-digit growth reported for both TH and CK. And importantly, it's driven by premiumization, moving towards higher value products.
And that's helping margins.
Definitely. The report notes margins around 20% for those two brands. That's quite strong. Shows the power of those international names.
And what about their other brands? Aero, Flying Machine.
Aero is apparently seeing ongoing margin expansion, which is good news. Flying Machine is lagging a bit behind Aero, maybe by about a year is how the report puts it, both on growth and margins.
Okay, so maybe some work to do there or just a different point in its cycle.
Could be. And then there's women's wear. That seems to be a real standout.
Yeah, the report mentioned it doubled, albeit from a low base, but still.
Doubled, yeah. And they're expecting it to keep growing fast, maybe around 30% going forward. So that's clearly a big focus area and a growth opportunity they're tapping into.
Interesting. And footwear, there were some issues there before, weren't there?
Yes, related to the BIS standards, the Bureau of Indian Standards. But the report says those inventory issues are now resolved.
Good.
So the expectation now is for higher growth in footwear, which is great because footwear often carries better margins than apparel.
Right, another potential boost to profitability. Which brings us neatly to margins overall. This looks like a major positive story in the report. Gross margin expansion of 270 basis points.
Yeah, huge jump. Up to 54% gross margin in Q4. And 270 basis points, that's 2.7 percentage points. Significant improvement.
What's the magic formula there?
Two main things highlighted: less discounting and that favorable channel mix we talked about, more sales coming from the higher margin retail and online D2C channels.
Okay, so they're holding the line on price more effectively.
Seems so. Discounted sales were down 2% year on year, and the report expects that trend of reduced discounting to continue.
And that flows down to the EBITDA margin, too. Earnings before interest, taxes, depreciation, and amortization.
It does. EBITDA margin was up 100 basis points, or 1 percentage point year over year, hitting 13.3%. That's despite them actually increasing marketing spend in the quarter.
Oh, interesting. So the gross margin gains and maybe some cost efficiencies more than offset higher ad spend.
Exactly. Higher gross margin and cost controls were the key drivers there.
And is that higher ad spend a temporary thing?
The report suggests it's expected to stabilize, likely around 4% of revenue going forward. So perhaps a strategic push that's now finding its level.
Okay. The report also mentions these adjacent categories and footwear having better margins.
Yeah, that's an important point. These adjacent categories, they already make up over 20% of revenue. And within that, USPA is apparently over 30%.
USPA being U.S. Polo Association.
Correct. And those categories, plus footwear, generally have higher margins than the core apparel lines. So that mix shift towards them is also helping overall profitability.
Makes strategic sense. And looking ahead, the margin picture looks even better.
The forecast is pretty optimistic, yes. They project another 220 basis points of EBITDA margin expansion between now, well, FY25 and FY27.
Pushing it up to 15%.
Targeting 15% in FY27, yeah.
Yeah.
Driven by, more gross margin gains, cost efficiencies, and just the benefits of scale as the business grows operating leverage.
Right. Now, let's touch on the bottom line, profit after tax. The report mentions an adverse figure, a loss after minority interest in Q4. INR 92 crore loss versus a profit last year. How does that square with the positive margin story?
Yeah, that headline number might look a bit jarring at first, but the key context provided in the report is that this loss was primarily due to deferred tax expenses hitting the books in that quarter.
Ah, okay. So not necessarily an operational issue.
Exactly. In fact, if you look at profit before tax, PBT, that actually grew 22% year over year. So the underlying operating performance was still improving nicely.
That's a crucial clarification. And what about debt? Are they managing that? Okay.
Seems like it. They've made good progress there. Net debt is down to INR 225 crore at the end of FY25.
Down from
INR 208 crore the year before. So a significant reduction.
what helped them bring it down?
Strong operating cash flow growth up 22%, and they also got better at managing their working capital. Working capital days improved from 53 to 50.
So collecting cash faster, managing inventory better, essentially.
Pretty much, yeah. All positive signs for financial health.
Okay, so despite that tax-related net loss blip, the underlying finances seem to be strengthening. Nuvama is sticking with a BUY rating and even bumped up the target price.
They did, yeah. Reaffirmed BUY and raised the target to INR 687, up from INR 630 previously.
And the rationale?
It's based on a sum of the parts, or SOTP, valuation, looking out to FY27. They like the positive like-for-like growth, seeing it as evidence of market share gains even when overall demand might be a bit soft. Plus, they point to the company's focus on sort of streamlining the portfolio and just becoming more efficient operationally.
And we saw that efficiency reflected in the return on capital employed figure, too.
We did. ROCE improved to 19% in FY25, up from 16% the year before. So they're getting better returns on the money invested in the business.
So overall, what kind of growth trajectory are they projecting?
For revenue, they're forecasting a CAGR, compound annual growth rate, of about 12% between FY24 and FY26. But looking out to FY27, they see even faster growth in profitability. Revenue EBITDA CAGR is pegged at 11 per 20%, 39% over FY24-27.
Wow, that 39% pay growth is quite punchy. It reflects the margin expansion and operating leverage kicking in.
Absolutely. It assumes things continue to go according to plan with margins and efficiencies.
And just quickly, those SOTP valuation multiples they used for the different brands?
Sure. For FY27, they used an EV/EBITDA multiple of 15x for USPA, 20x for PVH, that's Tommy and Calvin Klein, 10x for Arrow, and 5x for Flying Machine.
So different multiples reflecting different growth profiles and maybe brand strength.
Exactly. PVH gets the highest multiple, reflecting that premium positioning and strong performance. Flying Machine the lowest. And these multiples apply to their financial forecasts for FY26 and FY27 for sales, EBITDA, and PAT, underpin that INR 687 target price.
Got it. Okay, so let's try and wrap this up. Our deep dive into this Nuvama report on Arvind Fashions seems to paint a picture of, well, pretty solid progress.
I'd agree.
Strong growth in those key direct channels, retail and online D2C. Really significant margin improvement driven by less discounting and that favorable channel mix.
And a focus on reducing debt, improving efficiency.
Right. That net loss in Q4 seems more like a blip caused by deferred taxes rather than a fundamental problem, especially since profit before tax was up. The outlook seems positive.
Yeah, the core business trends look encouraging, according to this report. They seem to be navigating the market well, focusing on the right strategies with DTC, premiumization in key brands, and operational improvements.
Okay, so here's a final thought for you, our listeners, to chew on. Considering Arvind Fashions is really leaning into selling directly to you, the customer, and we're seeing this strong growth in brands like Tommy and Calvin, plus newer areas like women's wear and footwear. How might they take that even further? How can they leverage these trends not just to grab more market share, but to really build deeper, stickier relationships with customers in the years ahead?
That's a great question. Something beyond just the financials. How do they build that long-term loyalty in this changing landscape?
Exactly. Food for thought. Thanks for joining us for this deep dive.